Today we're unpacking exactly why the world's most famous investor, Warren Buffett, is sitting on a mountain of cash, more than $300 billion in cash, why he won't rush into deals, and what that discipline means for you as an investor. Buffett says, opportunities don't come every day, but they always come again. And that line tells you everything you need to know about his game plan: patience, selective action, and waiting for the fat pitches. I'm going to show you the clip of Buffett on CNBC. Watch how he explains the cash position, how he laughs about not trying to make his successor look good, and how he bluntly calls forced investing the dumbest thing in the world. After the clip, I'll walk you through my reaction on what he actually meant, why this matters for market timing, and how Berkshire's optionality works in practice. Then we'll dive into 3 stocks Buffett is loading up on right now, real companies he's buying hand over fist, and I'll explain why those picks make sense in the context of his cash-heavy stance. These are 3 names that could matter to your portfolio. If you only watch one video today, let it be this one. Smash the like button. Let's aim for 1,000 likes. Share it with someone who needs to hear Buffett's patience lesson, and drop your thoughts in the comments. Hit subscribe so you don't miss the next deep dive. Alright, cue the clip. Let's hear what Warren Buffett has to say.
This next question comes from 𝗣𝗟𝗏𝗧 in New York. He writes, today Berkshire holds over $300 billion in cash and short-term investments, representing about 27% of total assets, a historically high figure compared to the 13% average over the last 25 years. This has also led Berkshire to effectively own nearly 5% of the entire U.S. Treasury market. Beyond the need for liquidity to meet insurance obligations, is the decision to raise cash primarily a de-risking strategy in response to high market valuations, or is it also a deliberate effort to position Berkshire's balance sheet for a smoother leadership transition, providing Greg Abel with maximum flexibility and a clean slate for future capital allocation decisions? And I will add one line from another shareholder, Mike Conway, who asks, are you encouraged you may see some fat pitches coming your way?
Yeah. Well, I wouldn't do anything nearly so noble as to withhold investing myself just so that Greg could look good later on. Now, if he gets any edge when I leave, I'll resent it. So the amount of cash we have is we would spend, well, we came pretty close to spending $10 billion not that long ago, for example. But we'd spend $100 billion. I mean, and those decisions are not tough to make. When something is offered that makes sense to us and that we understand and offers good value and where we don't worry about losing. And the one problem with the investment business is that things don't come along in an orderly fashion, and they never will. I mean, it isn't like every day. The long-term record is sensational, but that is not a product. And I've had 200 trading days times 80 years. It's 16 million trading days. It kind of, 16,000 trading days. It would be nice if every day you got 4 opportunities or something like that, and and they were expected to be equally attractive. If I was running a numbers racket, every day would have the same expectancy of that I would keep 40% of whatever the handle was. And so the only question would be is how much we transacted. But we're not running that kind of a business. And so we're running a business which is very, very, very opportunistic. And Charlie always thought I did too many things. He thought if we did about 5 things in our lifetime, we'd end up doing better than if we did 50, and that we never concentrated enough. So that we would rather have, if we've got $335 billion now in treasuries, we would rather have conditions that are developed where we would have like 50 billion or something like that. But that just isn't the way the business works. And we have made a lot of money by not wanting to be fully invested at all times. And we don't think it's improper, actually, for people who are passive investors just to make a few simple investments and sit for their life in them. But we've made the decision to be in the business, so we think we can do a little better than that by behaving in a very irregular manner. But if you told me that I had to invest, let's say that we have a roughly 40 billion a year coming in, and we start with 335. If you told me I had to invest 50 billion every year till we got down to 50 billion, that would be the dumbest thing in the world to invest in that manner. Things get extraordinarily attractive very occasionally. The long-term trend is up. Nobody knows. And I certainly don't know. Greg doesn't know. Ajit doesn't know. Nobody knows what the market is going to do tomorrow, next week, next month, and nobody knows what business is going to do tomorrow, next week, or next month. But they spend all their time talking about it because it's easy to talk about. And but it has no value. I've never found anybody I want to listen to on the subject. And on the other hand, I've found that leafing through things like that big Japanese book that I can't read anymore, that's a treasure hunt. And every now and then you find something, and occasionally, very occasionally, but it'll happen again, that I don't know when. It could be next week, it could be 5 years off, but it won't be 50 years off. We will be bombarded with offerings that we'll be glad we have the cash for. And it'd be a lot more fun if it would happen tomorrow, but it's very unlikely to happen tomorrow. Very, very unlikely to happen tomorrow. But it's not unlikely to happen in 5 years, and then the probabilities get higher as you go along. It's kind of like death. I mean, if you're 10 years old, the chances that you're going to die the next day are low. If you get to be 115 or something like that, it's almost a cinch. Particularly if you're a male. I mean, all the records are held by females in terms of age. And I tried to get Charlie to have a sex change so he could test out whether... he did pretty well for being a male, I'll put it that way. Okay.
So, in this interview, Warren Buffett, the legendary CEO of Berkshire Hathaway, was asked one of those questions that really gets to the heart of how he thinks about money. The shareholder wanted to know why Berkshire is sitting on more than $300 billion in cash and short-term investments. That's roughly 27% of the company's total assets. To put that in perspective, that number used to average around 13% over the past 25 years. So, yeah, this is a massive pile of cash, and people are curious. The question basically asked whether Buffett's keeping that money on the sidelines because the market's overvalued, or if it's part of a bigger plan, maybe to give his successor, Greg Abel, a clean slate and more flexibility when he takes over. And another shareholder added a classic follow-up: are there any fat pitches coming soon? Meaning, are there big, juicy investment opportunities Buffett's waiting to swing at? Now, Buffett's answer, classic Buffett, funny, sharp, and brutally honest. He started off with a joke, saying he's not holding back investments just to make Greg look good when he takes over. He said, if Greg gets any advantage after he's gone, he'll actually resent it. Everyone laughs, but right away you can tell he's making a serious point under the humor. This isn't about a leadership transition. Buffett's not trying to hand off a perfect balance sheet. He's simply waiting for the right opportunities. He goes on to say that Berkshire came really close to spending $10 billion not too long ago, and that if the right deal came along, he'd have no problem putting $100 billion to work instantly. He makes it clear, It's not that he doesn't want to invest, he's just not going to do it unless it truly makes sense. That's pure Buffett philosophy. He doesn't chase, he waits. Then he reminds everyone that investing doesn't happen in an orderly way. Opportunities don't show up every Monday morning at 9 a.m. He says he's had about 16,000 trading days in his lifetime, and it would be nice if every one of them offered 4 great deals, but that's just not reality. Buffett says Berkshire's business is very, very, very opportunistic, meaning they move only when the right moment appears, not when the calendar says they should. And here's where it gets interesting. He talks about how Charlie Munger, his longtime business partner, always thought Buffett made too many deals. Charlie believed that if they'd just made 5 truly great investments over their entire careers and focused on those, they would have done even better. Think about that for a second. 5 investments over a lifetime. That's how much they value quality over quantity. Buffett says right now Berkshire's got around $335 billion in U.S. treasuries, but he'd actually prefer that number to be around $50 billion. Not because cash is bad, but because a lower number would mean better investment conditions. It would mean the kind of opportunities they're waiting for have finally shown up. But since that's not the case right now, he's fine sitting on the cash. He even adds that if someone told him he had to invest $50 billion every year until his cash dropped to $50 billion, that would be the dumbest thing in the world. Why? Because it forces action in a business that's built on patience. And he's right, the market doesn't reward forced investing, it rewards smart investing. Then Buffett hits on something that every investor should hear. He says nobody, not him, not Greg Abel, not Ajit Jain, not anyone, knows what the market's going to do tomorrow, next week, or next month, and he kind of mocks all the experts and commentators who act like they do. He says people love talking about it because it's easy to talk about, but in reality, all that talk has zero value, and he means it. Buffett's never been a fan of short-term predictions. For him, investing is about fundamentals, not forecasts. He even says he's never found anyone worth listening to on the subject of short-term market predictions. Instead, he spends his time treasure hunting, that's his phrase, flipping through financial reports, annual statements, sometimes even old Japanese company listings, just looking for hidden gems that most people ignore. And every now and then, he finds one. Then he says something that's vintage Buffett, calm, confident, and patient. He says opportunities will come again, could take 5 years, but it won't take 50 years, and when they do come, Berkshire will be ready. That's why they're holding so much cash. And not because they're scared of the market, but because they're ready for the moment when the market finally gives them something worth buying. That mindset is so different from what most investors do today. Everyone's in a rush to be fully invested, terrified of missing out. But Buffett's reminding us that having cash isn't a weakness, it's a weapon. It gives you the flexibility to strike when everyone else is too scared to move. Then, he ends on that signature Buffett humor, comparing the idea of waiting for opportunities to the probabilities of death. When you're 10 years old, the odds of dying tomorrow are small, but as you get older, those odds get higher. It's the same with markets. The longer you wait, the more likely it is that opportunities will eventually show up. And then, of course, he throws in a joke about Charlie Munger and longevity, saying Charlie did pretty well for being a male, since women usually live longer. It's funny, it's human, and it's pure Buffett, mixing wit with wisdom. So what does all this really mean? Buffett isn't sitting on cash because he's scared or because he's trying to make life easier for Greg Abel. He's doing it because patience has always been Berkshire's greatest advantage. He knows opportunities don't appear on a schedule. He knows markets move in cycles. And he knows that when the time comes, when everyone else is panicking or selling, that's when Berkshire's cash will become its superpower. It's a powerful reminder for all investors. You don't have to be doing something all the time. You don't need to chase every rally or every dip. Sometimes, the smartest move is to do nothing, hold your cash and wait patiently for that perfect pitch, because when that moment finally comes, and it always does, the ones who waited will be ready to swing hard and knock it right out of the park. Before I reveal the 3 companies Berkshire Hathaway is currently buying aggressively and why, this video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks, but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today, and take control of your financial future. Now, let's dive into the 3 stocks Warren Buffett is buying hand over fist. First up is Pool Corporation, ticker POOL, the world's largest distributor of swimming pool supplies and outdoor leisure products. If you've ever enjoyed a sparkling pool on a hot summer day, there's a good chance Pool Corp played a part in making that possible. From the smallest backyard oasis to sprawling resort pools, their reach is everywhere water meets relaxation. Warren Buffett is doubling down on Pool Corp, betting big on the enduring trend of outdoor living. He's not just investing in a company, he's investing in a lifestyle shift. as more people turn their backyards into personal retreats and gathering spaces for friends and family. Pool Corp dominates a fragmented market with a distribution network that's nearly impossible to replicate. Their vast network of over 400 sales centers stretches across North America, Europe, and Australia, ensuring that no matter where you are, Pool Corp is never far away. They supply everything from pumps and chemicals to backyard furniture, serving over 125,000 professional customers. Whether it's a contractor building a new pool, a maintenance company keeping water crystal clear, or a homeowner upgrading their patio, Pool Corp is the go-to source for all things outdoor leisure. This B2B model creates sticky, long-term relationships. Professionals rely on Pool Corp for inventory and support. These aren't just one-time transactions, they're ongoing partnerships that keep customers coming back year after year. The real magic? Recurring revenue. Pools need constant maintenance, so even in downturns, Pool Corp's revenue stays strong. Every pool installed is a future stream of sales for chemicals, parts, and service, making the business resilient to economic ups and downs. The company's growth is fueled by acquiring smaller distributors and integrating them into its efficient network. This roll-up strategy not only expands their footprint, but also brings operational efficiencies and cost savings, further strengthening their market position. Financially, Pool Corp is a powerhouse, boasting a strong balance sheet, robust free cash flow, and a track record of consistent shareholder returns. Their disciplined approach to capital allocation means they're always looking for the best ways to grow and reward investors. The pandemic accelerated backyard investments, expanding the installed base of pools, each one a source of recurring revenue for years. As families spent more time at home, demand for pools and outdoor upgrades soared, creating a lasting tailwind for Pool Corp. Buffett isn't betting on another pandemic, but on the ongoing need for pool maintenance. Pools aren't a one-and-done purchase. They require regular care, and Pool Corp is there every step of the way, providing the products and expertise to keep them running smoothly. Barriers to entry are huge. Building a similar network would be a logistical nightmare for any competitor. The scale, relationships, and infrastructure Pool Corp has built over decades simply can't be matched overnight. Pool Corp's scale gives it unmatched purchasing power and efficiency. They can negotiate better deals with suppliers, pass savings to customers, and invest in technology to streamline operations. This is Buffett's classic wide moat business, dominant, resilient, and hard to disrupt. It's the kind of company that can weather storms and come out even stronger on the other side. The trend toward outdoor living continues, with backyards becoming extensions of the home. People are investing in their outdoor spaces for relaxation, entertainment, and even remote work, fueling demand for everything Pool Corp offers. Pool Corp is evolving with this trend, offering more than just pool supplies. Their catalog now includes outdoor kitchens, fire pits, lighting, and smart technology, transforming backyards into year-round living spaces. Management excels at capital allocation, knowing when to invest, acquire, or return cash to shareholders. Their leadership team has decades of experience navigating both booms and busts in the industry. The stock has pulled back from highs, and Buffett sees value at current levels. For long-term investors, this could be an attractive entry point into a business with proven staying power. International expansion is a major growth opportunity, especially in Europe. As more countries embrace the outdoor living trend, Pool Corp is well-positioned to capture new markets and replicate its success abroad. Technological advances like digital tools for professionals make Pool Corp even more indispensable. From automated water testing to inventory management apps, they're helping customers work smarter and more efficiently. In summary, Pool Corp is a dominant market leader with recurring revenue, strong financials, and a long runway for growth. It's a business built for the long haul with deep roots in the communities it serves. It's not flashy, but it's a high-quality compounder, exactly the kind of business Buffett loves. Over time, steady growth and reinvestment can turn a quiet company into a powerhouse. While others chase trends, Buffett invests in the company, keeping pools clean for decades. It's a bet on consistency, reliability, and the simple joys of summer. We don't know the exact prices Berkshire paid for each pool share, but we do have the quarterly trading ranges for the periods when Buffett was buying, and that alone tells an interesting story. Today's buyers actually have an edge over Berkshire. The cheapest Berkshire could have paid in Q3 2024 was about $296.17 a share. By Q4, that floor had moved up to roughly $339.32. In Q1 2025, Pool pulled back and dipped to about $314.90 near quarter end. Then in Q2, when Berkshire's largest buys occurred, the low was about $285 a share. Right now, Pool is trading around $264.49, below any price Berkshire could have paid during its recent accumulation. On paper, that looks like a chance to step in ahead of Buffett. That said, Buffett doesn't chase short-term wins. He buys with a multi-year horizon. Pool today trades at roughly 26 times trailing earnings and yields about 1.73%, a below-average valuation for a business with steady cash flow. Those are exactly the kinds of metrics that would appeal to an investor who wants long-term durability rather than instant gratification. So, if you're comfortable with some near-term volatility in exchange for a position that aims for slow, steady growth and income over years, buying Pool at current levels is a reasonable consideration. If you want to beat Buffett on timing, the price comparison gives you an arguable edge. But if you want to think like Buffett, focus on business quality, valuation, and holding time, not on trying to outguess his purchase dates. Pool Corp is a quiet giant in the Berkshire Hathaway portfolio. It may not make headlines, but it delivers results year after year, quietly compounding value for shareholders. That's why it's making a splash with Buffett. In a world full of noise, Pool Corp stands out by doing the basics better than anyone else. Next, let's look at a healthcare giant you can't ignore. The story of steady growth and resilience continues, but in a whole new industry. Next up is DaVita, ticker symbol DVA, a name you might not hear every day, but one that plays a crucial role in the American healthcare system. DaVita is a leading provider of kidney care and dialysis services in the U.S., operating thousands of clinics nationwide. For patients with chronic kidney failure, DaVita is a lifeline delivering treatments that are literally essential for survival. Warren Buffett's Berkshire Hathaway has been quietly but steadily increasing its stake in DaVita over the years. This isn't just a passing interest. Buffett sees DaVita as a resilient, essential business that can weather economic storms. In fact, DaVita has become one of Berkshire's largest healthcare holdings, a testament to Buffett's confidence in its long-term prospects. The need for dialysis is driven by a chronic and unfortunately growing problem: kidney failure. Patients with end-stage renal disease require dialysis multiple times a week, often for the rest of their lives. This means DaVita's services are not just important, they're non-negotiable, making the company's revenue stream remarkably stable and predictable, regardless of what's happening in the broader economy. Economic cycles, recessions, or even global crises don't affect the need for dialysis. People can't simply skip treatments, which is why Buffett values this business so highly. The demand is consistent, and DaVita's clinics are busy year-round, serving a diverse patient base from all walks of life. In the U.S., DaVita and its main competitor, Fresenius, form a powerful duopoly, together controlling the vast majority of the dialysis market. This dominance gives DaVita significant pricing power and the ability to set industry standards, making it very difficult for smaller players to compete. Their massive scale brings not only purchasing power for medical supplies and equipment, but also strong negotiating leverage with private insurers and government payers. This helps DaVita keep costs in check and maintain healthy profit margins, even as healthcare costs rise. Regulatory barriers in healthcare are notoriously high. Opening a new dialysis clinic requires navigating a maze of permits, certifications, and compliance checks. These hurdles make it extremely tough for new entrants to break into the market, further protecting DaVita's position. A significant portion of DaVita's revenue comes from Medicare, which covers dialysis for most patients with end-stage kidney disease. This government backing provides rare revenue security in the healthcare sector, insulating DaVita from the volatility that plagues many other industries. Once a dialysis clinic is built and operational, it becomes a cash-generating asset for years, often decades. The high upfront investment pays off with steady, recurring cash flows, making DaVita's business model both durable and attractive to long-term investors. Management puts this reliable cash flow to work by paying down debt and aggressively buying back shares. This shareholder-friendly approach is classic Buffett. He loves companies that return capital to investors and focus on long-term value creation. Berkshire Hathaway now owns a massive stake in DaVita, signaling high conviction in the company's future. When Buffett makes a big bet like this, it's worth paying attention. He's known for his patience and discipline. Of course, risks remain. The company faces ongoing regulatory scrutiny, and changes in government reimbursement rates could impact profits. But Buffett is comfortable with these risks, given the essential nature of DaVita's services and its entrenched market position. To stay ahead, DaVita is investing in new technologies, such as home dialysis solutions. This not only improves patient convenience and outcomes, but also positions DaVita to capture future growth as healthcare shifts toward more patient-centered care. Despite its strengths, DaVita's stock trades at a relatively low multiple, reflecting investor concerns about regulation and reimbursement. But for value investors like Buffett, this is an opportunity to buy a high-quality business at a fair or even bargain price. Demographics are a powerful tailwind for DaVita. The U.S. population is aging, and rates of chronic diseases like diabetes and hypertension are rising. Both trends mean more people will need dialysis in the years ahead, ensuring steady demand for DaVita's services. But DaVita's competitive advantage isn't just about having the most clinics, it's about deep clinical expertise, trusted relationships with doctors, and a reputation for quality care. These intangible assets create a moat that's hard for competitors to cross. The company invests heavily in staff training and patient support programs, ensuring that both patients and healthcare professionals feel confident in DaVita's care. This focus on quality strengthens its brand and builds loyalty among patients and physicians alike. By prioritizing patient outcomes and satisfaction, DaVita not only improves lives but also reinforces its reputation as a trusted healthcare provider. This virtuous cycle helps attract new patients and retain top medical talent. With Berkshire's large stake, DaVita benefits from a stable shareholder base and a management team that can focus on long-term strategy rather than short-term market pressures. This stability is rare in today's fast-changing healthcare landscape. DaVita is a textbook Buffett investment, an essential service, high barriers to entry, predictable cash flow, and a price that offers value. It's a business built to last, with the resilience to thrive through economic ups and downs. Ultimately, DaVita's a bet on the enduring need for quality healthcare and the discipline of a management team that knows how to deliver it. It's a company that quietly powers the lives of millions, day in and day out. That's why DaVita remains a core holding for Buffett, and a company you can't afford to ignore if you're serious about long-term investing. Now let's turn to a food giant with a legendary brand portfolio. Finally, let's talk about Kraft Heinz, ticker KHC, a true titan in the food industry, boasting a portfolio of iconic brands and a global footprint that stretches across continents. With products found in nearly every American pantry and millions more worldwide, Kraft Heinz is a household name that has shaped the way we eat for generations. Despite facing some high-profile setbacks in recent years, Warren Buffett continues to stand firmly behind Kraft Heinz. His unwavering support signals his belief in the company's ability to stage a remarkable turnaround and reclaim its place at the top of the food industry. The 2015 merger of Kraft and Heinz was billed as a game-changing move, designed to create a lean, highly profitable powerhouse. The strategy was to combine two legendary brands, streamline operations, and unlock massive value. But the aggressive cost-cutting that followed, while boosting short-term profits, ultimately stifled innovation and weakened the health of these beloved brands. As consumer tastes shifted toward fresher, healthier options and the company struggled under a mountain of debt, Kraft Heinz was forced to take a massive write-down on its assets. The pain didn't stop there. A painful dividend cut rattled investors and cast doubt on the company's future. Many critics were quick to call it Buffett's biggest investing blunder. Yet, in the face of mounting pressure, he didn't flinch. Berkshire Hathaway remains the largest shareholder, a testament to Buffett's conviction and his willingness to weather storms for the right business. Why such loyalty? It comes down to the enduring power of Kraft Heinz's brands. Heinz Ketchup, Kraft Mac and Cheese, Oscar Mayer, Philadelphia Cream Cheese, and so many more. These are not just products, they're cultural touchstones woven into the fabric of daily life. These brands don't just fill shelves, they dominate them. They command deep consumer loyalty, built over decades of trust and familiarity. For millions, reaching for a Kraft or Heinz product is second nature, a habit formed in childhood and passed down through generations. That kind of brand equity is nearly impossible to replicate. Buffett understands that strong brands can weather economic storms and shifting trends. While fads come and go, the comfort of a familiar label endures, providing a steady foundation for long-term success. Today, new management is taking bold steps to revitalize the company. They're investing heavily in marketing, ramping up innovation, and working tirelessly to adapt their products to modern tastes. Whether that means cleaner labels, plant-based options, or global flavors, the company is renovating its core brands, breathing new life into old favorites, and expanding into fast-growing categories like snacks and international cuisines. They're also pushing hard into new markets, aiming to make Kraft Heinz a truly global powerhouse. The turnaround strategy is clear: reinvest in the brands that matter most, divest from slow growth or non-core assets, pay down debt, and channel resources into areas with the highest growth potential. It's a disciplined approach, focused on building a stronger, more resilient company for the future. Financially, Kraft Heinz is showing real progress. Debt levels are coming down, the balance sheet is healthier, and free cash flow is robust, giving the company the flexibility to invest, innovate, and reward shareholders. For investors, the company's attractive dividend is a major draw. It rewards patience and provides steady income, even as the company works through its transformation. For Buffett, Kraft Heinz is the classic value play. Buy a troubled company with valuable assets at a bargain price, collect income along the way, and wait for the turnaround to take hold. It's a strategy that has served him well for decades. He's been candid about overpaying for the deal in 2015, acknowledging the missteps. But for Buffett, investing is always about the future, not the past. He's focused on what Kraft Heinz can become, not what it once was. In challenging economic times, consumers often gravitate toward trusted, affordable brands. Kraft Heinz sits squarely in that sweet spot, offering comfort and value when wallets are tight. Scale is another huge advantage. With its massive distribution network, strong relationships with retailers, and a marketing budget that dwarfs many competitors, Kraft Heinz can get its products in front of more consumers, more efficiently than almost anyone else. Buffett's bet is ultimately on management's ability to breathe new life into these world-class brands, steering the company through a period of reinvention and growth. It's a turnaround story that demands patience and conviction. But if management delivers, the upside for investors could be substantial, both in terms of share price appreciation and ongoing dividends. The company is also investing in technology and data analytics, aiming to become more agile and responsive to changing consumer preferences. This digital transformation is key to staying competitive in a rapidly evolving marketplace. Buffett's continued holding is a masterclass in long-term thinking, focusing on the underlying business value, not the daily ups and downs of the stock market. It's a reminder that real wealth is built over years, not quarters. Today, Kraft Heinz offers a rare combination: irreplaceable brands, a revitalized management team, a stronger balance sheet, and a high dividend yield, all at a valuation that's hard to ignore for value investors. It's a deep value, contrarian bet, one that fits perfectly into Buffett's legendary playbook. While others may have written Kraft Heinz off, he sees opportunity where others see risk. Betting against Buffett has rarely paid off in the long run. His patience and discipline have outlasted countless market cycles and skeptics, and that's why Kraft Heinz remains a cornerstone of the Berkshire portfolio, a testament to the enduring power of great brands, smart management, and the value of thinking long-term. There you have it, 3 companies Buffett is buying: Corp, DaVita, and Kraft Heinz. Each is a lesson in value, moats, and long-term thinking. Successful investing isn't about chasing trends, but owning great businesses at fair prices and letting them grow. If you want to learn Buffett's principles, check out my Value Stocks Investing Master Course, link in the description. For exclusive stock tips and analysis, join the Stocks Galore Patreon community. Which of these 3 stocks do you think has the most upside? Let me know in the comments. Like, subscribe, and stay tuned for more investing insights. Thanks for watching. See you in the next one.